what do I need to do to backtest? Like, what do I need to track?
Metrics aren't so much a cookie cutter thing. It's not like if it has 70% win rate, it's great.
You have the test, you have the results, you know what should work.
This can be really useful because you can understand typically what a small cap does and what we can expect.
Where to even begin to think of a strategy to backtest?
You've done all the testing now. It's really just the live execution.
Welcome back to the show, everyone. Today's going to be an awesome day because we're doing something different. We're going to dive strictly into backtesting. And I brought my man, Go Shock Trades, aka Manir, who is going to be sharing and helping us out and understanding all about backtesting. And if you don't know why he's here, go watch his first episode because we talk about his story, and go follow him on Twitter because you will see right away why we brought him on the show. So welcome to the show again, brother.
Thank you so much. Thank you for having me again, and I'm happy to get into backtesting.
Absolutely. So, before we dive into all of just backtesting, let's show them what backtesting, just on a small scale, what it can actually do and how it can be helpful for someone. And to let everyone know, I asked you a while back, you and I had a private conversation, and I wanted to see some different stats. And, I worked with you, and you sent me a document just to give me a kind of a macro scale and small cap land for gap and crap. So let's go ahead and go into that.
Perfect. So what this document basically is we have around 10 years of data from small caps. It's everything above a 20% gap. So that's from previous close to the next day's open. And we're just looking for 20% in there. And it's below $1 billion market cap. So it's a bit high for small caps, but we wanted to have a wide range so we can flex around it and see how it kind of changes. And then this is what I normally call a dashboard. So this is all built in Excel, just using formulas. So if I click here, you can see it's just a countif formula, and these are median formulas. And what this allows us to do is go over this data tab over here and filter through all that data to get our statistics. So the main ways this has been really helpful for at least my trading is very general statistics. So when someone says, oh, what's the probability of something closing red if it has these kind of different variables, this is something that could tell you that. So it's not so much a simulating, hundreds of trades over 5 years. It is more telling you general statistics you can apply to your own trading. So normally for people that maybe have a couple years of experience or they're starting to get into small caps, this can be really useful because you can understand typically what a small cap does and what we can expect. And that helps us understand what's an outlier, what's a non-outlier. But yeah, where do you want me to start? What do you want me to go through first?
So what I like about this is, number one, to give more context, is I actually trade gap and craps for a long time, and I tracked all of my own a long time ago, and actually had conversations with Katani on the side and Ducks, and thank you guys for doing that. And what was interesting is the data that you pulled for me, it just reaffirmed that the setup that I like, gap and craps, is still there. And then on macro scale, it still works very well. And I think what's so important is it just gives you so much more confidence, because now not only have I already done the work, but now I'm also seeing another way of doing it, and how that also just reaffirms that I did it correctly. Okay, I got a good sense. That's so much more confidence than if you just go at it blind, because it took me a while to gain all of that information. It took me a long time, no joke, over a year just to get that many trades. And that's not even near how many trades you pulled. And so I want people to know that this data information can help you get that confidence. And I think the confidence is the biggest part when it comes to, you learn a setup, but if you don't have confidence in that setup, it's hard to really execute. But going in here, I'm very curious. Could you explain, because you said the median, can you explain why people, because I'm sure people are thinking, at least I was thinking this way, why don't you use the mean versus the median when you're looking at statistics like this?
Yeah, no, it's a really good question. It's a common one people ask me. So if we think about it, if we're normally just using a classic average, let's say we have maybe 4 numbers. Let's say we have 1, 2, and then 100. In an average calculation, that 100 is going to push that average way higher because we have that one outlier that's very high up. Whereas the median would be strictly the middle number of those amount of numbers. And that's a lot more accurate for our kind of trading purposes because we don't want to overfit for outliers. In trading, there's going to be that trade that went 1,000% or 500%. And we don't want to think that the typical trade is influenced by that outlier because that is an outlier in the saying. It's only going to happen maybe one every 100 times, 200 times. And that's mainly the main reason why you should be using median instead of average. I
appreciate you explaining that because at first I'm always thinking mean because I'm just not thinking this way, but when you explain that, it easily just makes sense. So, playing with this data, just to play around for just a second. Let's just say right now you have it. Could you explain what you have it right now it's set at, and then explain what each thing means? Because they have the 50% gap, just to give an idea of what people should be looking at here.
Yeah, sure. So these are pretty much all the classic small cap variables. So we've got market cap, so this is $1 billion. We have the max price, so just the max opening price for that particular gapper. We have the minimum pre-market volume. We have the minimum gap percentage, the lowest price, and then this is outstanding shares, min and max. And then we have the max gap over here. So just if we wanted to quickly change, we could see what is more of a common gap. So we go to 20% gap and then maybe just to 100% as the max gap. And we could make it a lot more small cap focused. Let's do below $15 as the open price. So we can see here we have about 3,000 samples from 2020 to 2023. And this is kind of matching all of those. And then we can see all the median statistics here. And then below that, we have the standard deviation, which can be used for further analysis.
What is the standard deviation? Is that an easy concept to understand? Can you explain that? I don't know if that's an easy explanation. Yeah,
sure. So it depends on what data point you're looking at. But for something like the high of day, if we have a standard deviation of 36, that means out of all the particular tickers there for that high of day, there's been a range. Because obviously not everything's at just a 10% high of day. There's a range to them. Some have higher, some have lower. And this is just a standard deviation of 1. There's multiple standard deviations. So the higher, if you go to standard deviation 3, it will be the biggest range, if that makes sense, compared to just more an average range. And this allows us to understand that, okay, the median is 10%, but on average, we could probably plus 36% to this 10%, and that's kind of an average as well. But with something that can be plus and minus, this can be the change percentage. So the change percentage is just open to close, and just a casual kind of change percentage. And we could have plus 26% on this 9%, or we could minus another 26% on that minus 9%.
Okay. And then looking at it on the left, it says close info on parameters. You got 72% or roughly 73% closed red on the day. That right there is so important to understand, especially on the macro scale, because what can you do with that? Just on a macro scale, if you're starting to create a strategy, why is this important?
Yeah, sure. So this is kind of why small caps is a great example for just a classic edge. The edge has never really changed that much. It's always that these are low market cap kind of stocks, and most of them aren't profitable. So most of them will, fade and kind of close red based on any extension. And the data just backs that up. So we can see this is just from 2020 to 2023. But if I zoom this out all the way to 2011, it's a very consistent percentage. Now, there were maybe less gappers back in those days. So if you look from about 2010 to 2019, there's way less compared to when COVID hit and everything went insane. We had so much more volume. There were so many more gappers. But the at least theme, or the macro edge, like I call it, so that's basically just the basic statistical edge. So that could be anything. It could be if it breaks out of a high of day, what is the percentage that it closes green? Just a very simple kind of formula, and we're just kind of understanding what is the macro probabilities of our trade. So we can see here, if it's a 74% close red, this wouldn't be something you want to ideally be longing, because even on macro scale, you're only going to be right about 25% of the time. So unless you have a very high R and you're risking very small, maybe that could work. But the more obvious trade here is that most of these small caps should be shorts. And that's very consistent. Most people think that. And the funny thing is when I first started trading, everyone said just short small caps. But you're very correct that without the data, it's very hard to have that conviction.
Yes.
But when you see it and you just see it all in numbers, you're like, that makes a lot of sense. It's we have 3,655 closing red here. It's a very simple kind of statistic.
Cobra Trading is the go-to broker for day traders and short sellers. And I'm not the only one saying this. In fact, Benzinga awarded Cobra Trading as the go-to broker for short selling. They have a heavy focus on direct market access order routing, so you have the fastest execution. They have some of the best locate prices and availability. They also have amazing customer service. I've experienced many different brokers, and it's why I use them every single day and why I'm proud to have them as our sponsor. Sign up now by clicking the Be the Trader referral link below and earn 1 free month of software with Cobra and 25% off all commissions. Now let's get back to the show. And what's interesting is, and you guys are probably wondering, okay, how do I even make this? How do I even, this is great. I get why it's important, but how do I make this? Well, just to let you guys know, I know Ghost Hawk. Ghost Hawk, right?
Yeah,
Go Hawk?
Ghost Hawk.
Ghost Hawk.
Yeah.
Okay, because I know other people are probably thinking the same thing. So, Ghost Hawk Trades actually offers, creating this type of information for you, hiring him one-on-one as a consultant, or just taking his boot camp where you can teach yourself how to do this. And I'm actually partnering with him to give it to you guys at a way better rate and a better discount. And everyone who goes through the show will be able to connect with him much faster and, have a great experience to learn how to do this. But I want to ask you though, what is that on the right-hand side where it goes high every hour? What does that mean over there?
Yeah, sure. So with most of my data sets that I give for people or make them, we include the high every hour. The reason for this is it allows us to create a very simplistic kind of price chart of the median tickers. So I think there's about 6,000 samples in this particular data set. And for everything that's meeting these variables up here, we're then doing the median high for every single hour. So we can do from 9:30 to 10. Obviously, it's 9:30 is when open, and then it goes to 10, then 11, 12, 1, and then we go all the way until close. And that gives us a very nice, simple price chart of how the highs are kind of playing out. Now, if it was maybe for a long strategy, it would be more focused on the lows. But most of the strategy that I work with are normally short, so we're focusing on the highs. And you'll see how this changes. So if we focus on maybe 100% gappers, and we move this to 1,000, we can see how that kind of price chart changes. Before, it was a larger spike in the morning. Now, we're not really paying attention to the particular numbers or the distance. Those are just median values. We're more paying attention to the general structure of that kind of price chart. So we can see from this 100, there's a way less of a peak from the open to 10 o'clock. Whereas with before, there was a way higher kind of push in the open.
Yep, and not only that, but you can also just in our generals, like using it as a macro scale, just always be thinking, generally seems like they peak out around 10:30-ish. Like there's a general sense there, which can help you have more confidence in your play, especially if you kind of want to adjust your stop to a different level of consolidation. You could be looking at this and say, or I could just keep my stop at high day and the odds are much higher they'll stay in the play. So things that you could be thinking about. But what I love it also that you did, and you explained to me very nicely, if you scroll down to the bottom on the left of the equity curve, you explained something to me a while back on private conversation about how y'all take so many different equity curves.
So this is a Monte Carlo simulation. This is all done through Python. Now, there are ones you can do online. The online ones allow you to just enter in your win rates, the amount of R you get on an average trade, and they produce something similar. The main pros and cons of that is the online ones don't have your historical trades. So what an actual Monte Carlo is doing is, let's say we have a backtest over 5 years, and let's say we have 1,000 trades over those 5 years. Yeah. You have two methods in a Monte Carlo. They can be combined or separated. We have a reshuffling, so that's where we're just taking, let's say, that was the first trade, and we move it to the number 10 trade, if that makes sense. So all of them are just getting randomly distributed. And the reason for that is the market is a random distribution. So when we're taking stuff live, we have no idea if they're going to be in the same distribution as they were in the past. So we want to see if we completely random just these trades, will it still be profitable? How many will be profitable over maybe 1,000 simulations? So you can see here, there's tons of lines, and I think this is maybe about 2,000 simulations. And then the black line here is the average performance. So this gives us kind of our new equity curve that is a more realistic and more robust version of that strategy equity curve. As we can see, okay, on average out of these thousands of simulations of reshuffling these trades, this has been the average performance. And this would be something you would typically be agreeing with, like this looks quite good, we're going in the upper right hand corner, we're not drawdowning too much, this would be generally like an acceptable Monte Carlo. And then the other method is a resampling method. So normally what's going on there is we can pick any trade from those 1,000 trades until we add up to 1,000 trades in total. So that means you can also pick the same trade. So that's really good because it allows you to see, well, maybe if you had that loss, 4 times, would your strategy still be profitable? And that allows us to kind of get a more insightful and realistic perspective of our strategy, because just one single backtest is just one single distribution. And when we go into the markets, there's, it's random distribution. So we want to pay attention to that.
I know right now everyone's rewinding this and re-listening to this because this is, there's a reason why I'm partnering with you, brother, because you're going to be able to help so many people. At the end of the day, like he's basically created a sheet that can teach yourself this, just like a quick how-to guide that we're giving away. You just click the link below. You get it completely free. Thank you so much, brother, for making that. Also, it's like It's
My
awesome. He
pleasure.
went above and beyond what I asked. I was just like, hey, man, let's just make sure we create something that everyone can use right away after watching this episode. But to start with backtesting, where would someone even start? Like, well, let's not even start there. What is it exactly? Because I know some people are probably not even sure what it is.
Sure. So backtesting is simply a way of testing a trading strategy on historical data. We're just simulating the trades over that historical data, and we're going under the assumption that if historically it was profitable, it will most likely lead to profitable results on the live market. That's kind of the main purpose. We're just doing a pre-check before we actually trade a strategy live to see if it's been historically profitable.
And how does someone even do it? Like, can you only use Excel? Like, do you just like how is someone's going to get all the data to begin with?
Yeah, sure. So there's multiple ways you can really do it. Really depends on what market you're going after. So probably the easiest, most accessible markets is like crypto. They've got data you can download for free. Whereas with equities and futures, it's a bit more challenging. It just depends what kind of route you go down. So obviously the method everyone can do is just manual tracking. It's a good place to start. I started with manual tracking. There are obviously, issues with it. There's human bias on it. You can be lazy with it. You won't maybe, enter the right number. There's all those kind of things that come in with it. But it is a good place to start. If you want to just get started, you can start manually tracking. And in the Excel sheet we included, you can start manually tracking yourself, and it gives you some like example data points. After that, really what I'd push everyone to try and go to is where you download historical data using code to some extent. So whether that be 5 years, 10 years, normally if you're going through code, the best thing about it is it provides you ultimate like leverage. If you write code once, you can use it for 5 years of data, 10 years of data. Most of the time it doesn't really change, which is great because if you spend an hour manually tracking, it's going to only get you an hour of results, which is which adds up when you're doing it over years. And you can spend that time, doing something better, like focusing on reading a new trading book, reading new content, focusing on trading, really anything like that. And then for futures, there's some really good methods. You can use platforms like NinjaTrader, Sierra Chart. I think there's maybe one more, I think like Quant Connect or something like that. And those sometimes provide data. Obviously, you pay like a fee most of the time, depending on how much data you're using, if it's live data, all those kind of things. But those are good methods as well. Even with NinjaTrader for futures, you'll still need to know some coding language. Normally they use C#, whereas for small caps and equities, you can use Python, which most people would have heard of, or you can look up quite easily. Whereas C# is a bit of a older, outdated kind of language.
So let's say regardless which way they go, Python or manually tracking, or C, as you mentioned, or C coding, or C#. Is that what you said?
C#, yeah, C#.
C#. My wife's probably laughing at me. She knows all about that kind of stuff. But with that being said, how do I know what to even like? What do I need to do to backtest? Like, what do I need to track? Like, what do I need to be thinking about? Like, how should I even approach it?
Sure. So I have a general framework I normally kind of follow. So normally you've got an idea. So that can be from really anywhere. It could be from books, YouTube, really anything. Next, you want to quantify that idea. So normally the more you do it, the better you get at quantifying an idea. If you're very new to thinking kind of in code or thinking in like if and or statements, then it's a bit difficult. But as you kind of put in practice or talk to people who also think in kind of code-ish, it really helps. So an easy example of this is just like if you're looking for a stock that looks weak, that is great starting places, but then you need to define what actually is weak, and you need to dig deeper and kind of quantify each part of it. That's normally where people get stuck, because if you only think in like weak or strong or bullish, you need to actually define those terms in something that can be tracked or measured. After you've got that, so after you've quantified your idea, I normally do like a pre-sample test. So this is normally like 20 to 50 samples. You can do this by hand. I sometimes do it by code, kind of whatever is quicker. Reason for this is whether you're dedicating money or time into a strategy, you want to know that it's working recently. There's no point really finding out something that's worked, historically really well, maybe back in 2019, but doesn't work nowadays. So you just want to do a quick check by hand or by code if you can code, just of 20, 50 samples. After that, you don't really need like a huge edge shown there. It's a very small sample, so you're just looking for something that looks kind of promising. If it looks promising, then you can dedicate more time to it. After that, you're going to pull something larger in size. That's going to be probably like 5 years of data, 10 years of data, whether that be hiring someone to help you code it, or if you're going to do it all manually, or you're going to use a software, whatever you'd like. You just need to make sure you're getting 5-10 years of data. Ideally, you're getting over 200 samples. it can be both ways. So depending on the market, you can have a lot of years of data, which can kind of help the robustness and kind of statistical significance of your data. Or you could just have a lot of samples. So if you have 200 to 1,000 samples, that's great. You're looking pretty good over there. There's no kind of like base number. Just really above 200 is quite good. After that, you're normally doing your historical backtest. So this is where you're probably coding your strategy to work over over that data. Some people have done it through Excel. So if you're an Excel whiz, you maybe could do it if you have all the right data points. But normally it's easier to do in Python or whatever language you're using. After that, you've got robustness tests. So this is Monte Carlos, parameter sensitivity, out of samples. You've got all these kind of different methods to make sure that your strategy is robust and isn't just by random chance or something like that. Lastly, after that, you want to analyze the whole strategy, the returns, the performance metrics. Normally through there, the thing people miss is that metrics aren't so much a cookie cutter thing. It's not like if it has 70% win rate, it's great. You can have both sides. You can have a very low win rate strategy, that's awesome. You can have a high win rate strategy, that's awesome. There's no metric really that tells you this is an awesome strategy. In my opinion, most of it can be told through the equity curve. So a lot of it is you should be looking at the equity curve, seeing if this is something you could have historically handled. It's all good having a profitable strategy, but if you can't execute that, whether if you're doing it manually or stomach, having that algo go into drawdowns that are very deep, you need to be able to handle it. So you should be looking a lot of the time at the equity curve, thinking very deeply if you can actually handle it and if you can execute it, because there's no point putting it live if you can't handle that volatility. And if you can't, then just go for low drawdown strategies like myself. I'm a wuss. Yes. I can't handle lots of volatility. So I go for low drawdown, kind of higher win rate, lower R strategies, which are typically the kind of performance metrics I look for. After that, you've got a forward test. So that's normally a month to 2 months of trading it live, whether that be on a sim account or just, very small size. That can be manual or algo, really doesn't really matter. The whole point there is you're trying to look to see, is this kind of the similar results to the backtest? Does it look kind of similar? Many ways to do this. Most of the time, it's just easiest to look through performance metrics. Does it have similar stats over the next 2 months as it has, previously in the backtests? And also, you want to give yourself some safety. If you turn it live and you put full size straight away and not do a forward test and it goes into a deep drawdown, that is a very painful experience, and I've done it myself. So you want to test it at least for a month or two. After that, it's all up to you. You can go full size. I know people that just slap the whole account on it. I know other people that, add slowly into it. It's really, you've done all the testing now. It's really just the live execution. So it's now more about maintaining your psychology so much around it. Can you handle it? Are you going to change the parameters next week? Something like that. All those kind of things you don't want to do. So it's just about adding slowly into it or going full gun.
So speaking of that, change of parameters, because you mentioned like you do all this work and then you have the test, you have the results, you know what should work. Some people go full in, some people slowly edge in. But you definitely recommend that they, don't just dive in right away all the time, because especially if you're new at this, because you kind of want to make sure you did it right and so forth. But what I love is how you said don't tweak it here. You could tweak it, because if you tweak it, you just mess up your whole system. But some people are probably thinking when do you tweak? Should you tweak it at all ever? Or should you just always put money in until it just drains your account? Because what if it happens to just not work, right? Do I just let it drain the entire account because my equity curve shows me that it's going to be profitable and maybe I'm just in that one drawdown period? What's your suggestion there? Because I know people are probably thinking that.
There's multiple approaches to it. So one thing I guess there's so many things to backtesting you can slide over, but one thing I should have mentioned previously was during a Monte Carlo, a great thing about it is because you're doing thousands of simulations, you get to see what is the max drawdown you could really have realistically. And that's a really key metric, because when you're thinking about how much size you should put on this particular strategy, that should be really key in your mind. You should be thinking, can I handle something, that big of a percentage? And then kind of sizing accordingly to that. Now, people don't like that because you're normally not sizing that much, and it's, you're trading smaller size than you want to. But realistically, in that case, if that happens, you want to be able to survive it. And the worst thing you can do is stop a strategy that could have returned and, bounced back, but you just ran out of capital because you put too much capital on risk per trade. So that's one thing to really think about. And then realistically, for changing parameters, it's very tough. I think normally I only really look every month to every quarter. it gives it just enough time where I'm seeing, okay, it has something fundamentally changed. So an easy one you could have like thought about is, a mean reversion strategy back in 2019 before the whole 2020 craze. Once COVID happens, that's quite a clear thing that, okay, the market has changed. There's way more volume. There's, all these kind of different variables have changed now. And that's, something where you can really think about and change it accordingly.
That's a good point.
Yeah, but you need to be very wary of when has something significantly changed and when has something just kind of changed. So a classic one is people think small caps change so much. They do, but they fall into a market cycle. There is times of less, there's times of very high volatility, and your strategy should be able to survive that. And there's not so much a crazy event like COVID that's happening that should change all your parameters, if that makes sense. You should only be according to it once that crazy moment has happened and everything is like the whole game has changed. Then you can start changing parameters a lot. If you're changing them every week, you're not trading a strategy. You're just changing the same parameters, every week to see what would work. So realistically, you have to have the guts to kind of stick with it.
Basically, I mean, someone has to generally, to even get started, they have to have an idea. They have to know what they want to trade. They have to know like what they kind of like. So what do you recommend? Like, do you recommend they kind of just like look at the market, or do you recommend them, how do they kind of have an idea? Because there's those traders who've been trading for 2 years and they're going to watch this. I'm like, oh, I have an idea what I like. And then there's those traders who are watching this who have no idea. So like, how would you suggest those traders to like kind of think, or where to even begin to think of a strategy to backtest?
Sure. So if someone's very new to trading, then I'd say you kind of have to stomach that the first year is just going to be experience. You're probably going to lose money, or maybe you trade on sim or something like that. And that year will most likely give you a lot of ideas of what you maybe want to trade, whether that be through mentors, just watching the market every day, seeing what you notice. For me, a big inspiration has been YouTube. So someone like yourself watching podcasts with other traders, you'll be surprised how many traders let slip decent edge just talking to someone. So you have to be hyper aware. You have to be very curious.
I'm just kidding. I had to do that. That was funny.
You have to be very curious. If you hear someone say something, it's worth testing it. Like the worst case is not a profitable strategy, which is 90% of strategies, and maybe you find something that's very cool, or you find something that you could add to a strategy or combine or anything like that. So curiosity is a big one. I'd say reading is something I should have done more of. I do a lot more of it nowadays, but I think when you get into trading, you think it's all fast money. So you think reading a book about trading is very boring, at least for myself. But a lot of books have very decent ideas. They might be slightly outdated, but you can adapt them, you can change them, you can try them and test them, which is just a big part of trading. So normally it's time, books, other people, and YouTube videos really.
Have you tested the turtle traders? Like, were you ever curious?
Oh, the actual turtle trader strategy?
Like, were you ever curious about it?
Not so much. Not really the turtle traders, but I've tested a lot of Robert Cavier's. I think I'm butchering his second name, but I've tested a lot of his strategies. There's a great book called Trade Like a Hedge Fund, 30 Correlated Strategies, or something like Uncorrelated Strategies. That's a very good one. I took a lot of strategies from there for futures. And then really realistically, small caps has not changed. It's kind of annoying how my first year I knew what worked, but I had no conviction in it, so I just messed it up every day. I trade pretty much the same as I did in first year if I just was better and convicted to it, really.
Yeah, and here's the other thing: it does take skill to also execute, like and execute, like even if you have conviction, even if you are confident, like over time you'll get better at executing. I think that's just part of the game. But this is such a huge part, though. This is such a huge part because this can extremely like propel your confidence, at least, much faster than anything else. So this is why I really wanted to bring you on again, because I think people, that's one of the biggest struggles is like they're always looking for a strategy from someone else. But now you're like, you can find your own strategy. So what can you not track? What can you not backtest? Like, should I ask that question rather than what can you track? Because I'm sure you can track a lot. So what can you not track?
Yeah, that's a very good question. What can you not track? I'd say that the main ones in small caps is dilution. Currently, at the moment, it's just not really possible. You can track it manually, but you can't really code it to pull that kind of data. Hopefully, at some point, if someone's watching, please create a dilution tracker or something like that, like an API. That'd be great. Most other things you can, really. I think a common one I try and dispel is like you can't make order flow systematic. I've tried multiple ways of doing it, and you kind of can. Order flow, realistically, at the end of the day, is just numbers coming in. So it's actually one of the easiest ones to track. The hard part is really getting data. So it can be kind of expensive data to get. But you really can turn the feeling of tape into something that's systematic. It may not be as good as someone that's been watching tape for 10 years. I'm not saying that, but it could be better than someone that's barely watched it for a year or something like that. Some people do just have very good intuition. It's just general experience, pattern recognition if you've been watching it every day. Dilution and tape.
What about
that's
news?
Pretty much it. I think everything else. News you can get. Historical news you can get.
And all this data you're getting, because we talked about either tracking it manually, which would take forever, which I had done, and it's almost the most frustrating part of trading. And then there's pulling the data, like with Python. If you do that, like, can anyone, like, do you have to pay to pull the data? Like, how does that work? Like, I'm just curious.
Sure. So if you know Python, a couple of good data providers you can use. Pretty much what we use is APIs. So it's just like, think of it almost like cloud storage. That's kind of a bad description of it, but just think about it, storage. You can take this kind of data and you're formatting it and data cleaning it. So there's a couple of providers like Polygon. Polygon's really good, very cheap. I think they're no longer really a startup, but they were a startup for a while. Very good market data. They provide a couple of the classic big names, I think like Robinhood. I think for 5 years of data is about $29 a month. Best thing about them is they don't limit your amount of API calls per minute. It's unlimited, so you can absolutely use the hell out of them. Most of the other ones charge you per API call. So things like Alpaca, things like that. If you want fundamental data, financial modeling prop is a great choice. They've got a lot of earnings data, things like that. I will say a big thing with all data, when you're having this much data, there's going to be miscalculations, there's going to be small errors, there's going to be margin of error. Now, is it worse than human error? I would argue no, not even close. But it is something. It's going to be about 2%. And a whole topic I could get into, but data in trading isn't standardized. So even between brokerages, you'll notice different price data. Maybe on DAS, it has this huge spike this one time, but on another platform, it doesn't. Those are all data kind of changes based on different platforms. Easy one to spot is volume. If you look on two different platforms, the volume probably won't be the same. So a lot of things like that kind of adds into it.
The margin of error. So like, and you always. So I guess if it's like 2-3%, like, I mean, does it?
No, it wouldn't really matter.
Yeah, it wouldn't really matter at that point. So I want to make sure I'm gonna flex my little, I would say, algorithmic brain here, which is nothing. So when you say make a call, and because some people are hearing that and they might be like, "What the hell is that?" Is that whenever your algorithm or your code is interacting with the actual cloud itself, the API, or because API is automated processing. I mean, what is the API? Go ahead and explain that, because I know in my head I know what you're talking about, but I also can't even explain it. So if you can go ahead and explain that.
I don't think I remember the each letter word for it.
That's okay about the word, but can you, because we're saying like if they allow you to make unlimited calls, can you explain what that is? Because some people will probably have zero clue what that means.
Yeah, sure. So once you're interacting with an API, for each endpoint you're using, so that's just when you're using code, there's going to be different endpoints for different things. So if you're getting price data, that will be one endpoint. If you're using something else like market, if you like fundamental data, that's going to be a different endpoint. And for each one you're getting from there. So let's say this doesn't apply to Polygon if you start using Polygon, but for classic ones for APIs, let's say if you're pulling 1 day of gappers, that's going to be one API call, for example. And if you do another one, that's going to be another API call. So sometimes they charge you per one. It's normally like in the cents, but then it adds up because you're doing a lot more.
You're pulling a lot. Yeah.
But nowadays the business model for most APIs is you charge a flat fee, and then hopefully they just have enough scale where it kind of makes profit anyway. So that's normally how that works.
Okay. And I also wanted to find out, just in regards to the backtesting itself, how, I don't know the word, but it's like how many variables. How many variables should you have or should you not have? Like, is there a rule around that? Like, because, some people might hear this and be like, well, I'm going to track everything. I'm going to track like float, cap, industry, news, like XYZ, volume, price. Like I'm gonna track every single thing there is because now I'll know for sure. You know, like so, like you know, what's the pros and cons to this?
So I would say it's totally fine to track as many things as you want. It kind of comes down to mental capital though. So it's all good to say you've got, I don't know, 1,000 variables you're looking at, but realistically, are you looking into each single one? I was working with a guy recently and he had like, it was crazy. I think he had like 120 variables, but he really didn't know what variables did what or how it really affected his system. So it was kind of like over-analysis paralysis. I think that's the term.
Yeah. Analysis paralysis.
Analysis paralysis, that's exactly what it is. So yeah, if you dive in too deep, you're probably going to get stuck and you're going to be overwhelmed and you're not going to actually do the proper research into each one. So I'd normally say try and go in chunks of like 20, really look into 20 variables, see what they do, see how they affect a strategy, and then, move on to the next. I would say most of the time, most strategies are the simpler the better. So it's a common rule of thumb that you want around 4 to 10 variables. It does depend on markets and different strategies, but if you're getting above 20 variables on a strategy, that's quite worrying because it's just so many variables. There's so many ways you could have overfitted your data on historical data that you don't want that many variables. And normally the simplest things over time have always worked the best. So you ideally want a lower amount of variables that you're actually paying attention to, or at least implementing into a strategy.
Before we start to wrap this up, can we actually track like splits, reverse splits? Like, can we track things like that as well?
Do you mean like when they happened, or like?
Yeah, like if they've happened, because you're looking in the past, maybe. And
Yeah, you completely can track them. So in Polygon, they kind of have a adjusted version, so it adjusts for reverse splits, and they have an unadjusted version of data. So you can look into both. The main side of that is if you're looking at daily charts, you're going to want adjusted because otherwise you have a crazy daily chart, and most of it isn't very accurate. Well, not inaccurate, but it's crazy prices because of the reverse splits.
Yeah.
So you normally want to use adjusted. But if you're doing intraday, for example, with gappers, you're going to want unadjusted because that reverse split wouldn't have changed the price action of an intraday day, if that makes sense. So if you're pulling intraday data, go for unadjusted. If you're going daily, probably go for adjusted.
So look, I already know this right here. Like, this is why I wanted to connect with you. This is why you are one of my friends now, because this is so valuable, man. I appreciate it so much. I know I've said it already, but could you explain what people will get whenever they click the link below and what you created?
Yeah, sure. So it's mainly just a general guide to backtesting. I go through kind of the general layout, so the 9 steps to it, and then I really take you through the first 4, which everyone can do. So no matter if you have coding experience or anything like that, you can go through the first 4. And then I also include an Excel spreadsheet, which goes over some different kind of data points, mainly for small caps that you can focus on. So I know when I first started, I didn't really know what data points to actually track. So it includes just some normal ones you can kind of start tracking yourself. And it gives you just the basic framework to start and get going with tracking.
Absolutely. So definitely check that out. And let me just say this, like, you're going to want to at least get that free Excel because a lot of people don't even know how to start that off. And this will give you a good starting point to start tracking manually if you just want to start doing it right away. But again, look, Manir, I appreciate it so much, my man, for being here and sharing some of this knowledge. Could you let people know how they can actually find you and actually say your Twitter name? So that way I cannot keep butchering it.
Sure. So it's Ghostwalk Trades on Twitter. Feel free to follow me. Pretty much everything else you can find through that Twitter page. I do run Unbiased Trading, which is a coding service for traders. So if you want, you can go through my Twitter page to that website. But thank you for having me. It's been a pleasure, and I absolutely love your series.
Absolutely. And I 100% have already worked with him once, and I already loved it. So, you got my vote. So thanks again, brother.
Thank you.